There was a time when a single tulip bulb cost as much as a grand house on an Amsterdam canal. People believed the price of that flower would climb forever. Then one morning nobody was willing to buy, and the price turned into waste paper in a single day. What is truly astonishing is that this story has repeated itself for 400 years, changing nothing but its name. The tulip simply became a railway, then the internet, then an apartment, then a crypto coin. Every crisis arrives wearing a new face, but tear it open and the insides are eerily identical. A crisis detonates at the exact moment greed turns into fear. And the thing that pulls the trigger is always debt, or, in the fancier word, leverage. Leverage means borrowing other people's money to make your own bet bigger. Like a lever lifting something heavy, a small amount of money buys a very large asset. On the way up, you earn several times more than everyone else, and on the way down, you collapse several times harder. So debt is the fuel of every boom and the detonator of every bust. Now let us thread the great crises of human history onto a single line. Why clever people have fallen into the exact same trap for 400 years running. The answer to that is waiting at the very end. Our story begins in the Netherlands of the 1630s. At that moment, the Dutch Republic was the richest country in the world, and yet this wealthy nation somehow lost its mind over a single flower. The tulip had originally come from Central Asia as a rare and precious import. Above all, the bulbs infected by a virus, which broke their petals into flames of color, were treated as one-of-a-kind works of art. The problem was that people stopped buying the flower for the flower and started buying it for the price it would fetch tomorrow. We call that speculation, buying something not for its use, but purely for the profit when you sell it on. The price of a single bulb climbed past 10 years of wages for a skilled craftsman. People even traded tulips that had not yet been planted in the ground as slips of paper, buying and selling a thing that does not exist, yet is called a futures contract. Everyone believed they could pass it on to someone else for more, and so the price kept rising. Then, in February of 1637, at one auction house, the buyers simply stopped showing up. As fear spread, the price fell to 1/100th of its peak within days. And so the first bubble in human history ended, laying human nature bare for everyone to see. Now jump forward to 1929 and to America. With the First World War over, the United States was enjoying a wild and giddy boom. People were making easy money in stocks, and everyone was piling into the market. There is a famous story from that time, when even the boy shining his shoes started handing out stock tips. One investor sensed that it was finally time to sell. When everybody knows about the party is already over. The problem was that this party had been built on top of debt. People put down 1/10 of the price of a stock and borrowed the rest. On the way up, they made 10 times the gain, and when it turned, they were instantly buried in debt. In October of 1929, as prices began to break, the demands to repay those loans came pouring in. In the panic of everyone trying to sell first, the market simply collapsed. Thousands of banks failed like falling dominoes, and people's savings vanished into thin air. 1 in every 4 American workers lost their job. It was the beginning of a 10-year winter when the world truly believed capitalism was dying. Our next stage is the 1970s. The crisis of this era is a strange one. Normally, when the economy is bad, prices fall, and when the economy is good, prices rise. But in the 1970s, something bizarre happened, as prices and unemployment shot up at the very same time. Economists gave it a name, stagflation. It is stagnation and inflation welded into one word. In plain language, it is the worst possible combination, no jobs and prices going insane. The trigger was oil. In 1973, the oil-producing states of the Middle East shut the valve for political reasons. As the oil price multiplied several times over, the entire Western economy, which ran on oil, began to stagger. Factories stopped, prices jumped, and people lost their jobs. There is one more hidden piece of background here. In 1971, America scrapped its promise to exchange dollars for gold, and the anchor holding up the value of money disappeared. With the currency off its leash and an oil shock on top, the world had to wrestle with inflation for the best part of a decade. Now we come to the name that still hurts the most, 1997. Back then, Korea was standing at the summit of its high-speed growth. It was the tiger of Asia that the whole world envied. But behind all that glitter, a dangerous secret was hiding. The great conglomerates had borrowed far more from the banks than they could ever handle, purely to grow bigger. The larger problem was that much of that debt was short-term foreign debt, borrowed from abroad on very short notice. Short-term foreign debt means money owed to foreigners that has to be repaid within months. They had built an enormous house, and it stood on thin ice that could crack the moment the lenders asked for their money back. When the fire that started in Thailand spread across Asia, foreign banks took fright and began pulling their loans back all at once. Giants like Hanbo, Sammy, and Jinro toppled one after another. As the dollars in the national vault ran dry, the value of the won was cut in half within 6 months. And so, in December of 1997, Korea went to the International Monetary Fund and asked for a bailout of $58 billion. Ordinary citizens carried the gold out of their own drawers and handed it over, a nationwide gold collecting campaign to pay down the country's debt. The bill for all that growth had finally arrived, and it arrived all at once. Cross into the 2000s, and the crises get more sophisticated and more cunning. First, the year 2000 and the dot-com bubble. Stick the word for the internet, .com, onto a company name, and the share price went wild. Companies that did not earn a single cent were handed valuations in the billions. Everyone was shouting that the internet was a brand new world, so the old yardsticks simply did not apply. Hold on to that dangerous belief, because the words "this time is different" will come back later. When the bubble burst, the Nasdaq fell a staggering 78% from its peak. And then the truly catastrophic accident arrived in 2008. American banks were lending people the price of a house, even when those people had no ability to repay. They sliced that dangerous debt into pieces, blended it all together, and sold it around the world wrapped up as the safest, top-grade product. Difficult financial engineering had dressed garbage up to look like jewels. When house prices turned down, the time bombs went off in a chain. Lehman Brothers, a giant investment bank with 158 years of history, vanished over a single weekend. The fire that started in America burned through the entire global financial system in a matter of days. The most recent crisis is one we lived through ourselves. In 2020, the coronavirus brought the entire world to a halt. As factories and shops closed their doors, the stock market crashed at the fastest speed in recorded history. Governments and central banks answered with a prescription nobody had ever seen before. They printed money in effectively unlimited quantities and poured it into the markets. This is called quantitative easing. It is a policy where the central bank creates new money, buys up assets with it, and floods the system with cash. Thanks to it, the economy rebounded astonishingly fast. But there is no such thing as a free lunch. With money sloshing everywhere, 2022 brought the worst inflation in 40 years. When central banks jacked interest rates up to drag prices back down, everything that had been surviving on debt began to creak. The bill for all the money sprayed out to stop the pandemic came back a few years later, under the names inflation and high interest rates. The cure for one crisis becomes the seed of the next, and around it goes. That loop is exactly the story we are living inside right now. So, now we return to the question we began with. Why do clever human beings keep falling into the same trap for 100 years on? Two economists, Carmen Reinhart and Kenneth Rogoff, analyzed 8 centuries of crises and found a startling pattern. At the root of every single crisis sit arrogance and ignorance. Ignorance is forgetting that this exact thing has happened countless times before. Arrogance is saying this time is different and believing the old lessons do not apply to us. The tulip, the Great Depression, the dot-com boom, 2008, every one of them said exactly that. To be fair, we should also put the opposing view on the table. Some argue that crises come from human nature itself and therefore can never be prevented. Others argue the opposite, that if you watch the debt and build the right regulation, you can shrink them a great deal. The truth is probably somewhere in between. But one thing is certain, the name of the asset will keep changing, yet greed, fear, and the trigger called debt will stay exactly as they are. When the next bubble arrives whispering that this time is different, if you can remember today's script, you are already one step ahead of everybody else. If you want deep dives that dig all the way to the bottom of the big currents in the economy, subscribe and catch the next one.